Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah. And Amar and I are with Client First Capital. And Amar, I know we want to talk about uncertainty in the market and how investors can navigate a world of uncertainty. But but I know you have some slides that you want to share, and I think it's probably be good to just have some perspective on uncertainty and downturns in the market using data, right? And then we can launch from there, maybe into our discussion on how to handle uncertainty.
Yeah. Nobody has a crystal ball, Cary, but I got this little magic 8 ball that tells me exactly what the markets are going to be doing.
Yes, sir.
I'm just kidding. So let's hop into some slides here. So I pulled a deck from First Trust, and we can share this deck with whoever's watching, but it highlights a couple key things. So I know right now, front and center in most clients' minds, as well as individuals out there, are what's happening with Iran, oil, and things like that. And so in this first slide, we have highlighted all the different war times in the past, and put the stock market, the S&P 500, juxtaposed to it. And I think it's interesting to see here that whenever there was a key event date, the 1-day return, 1-year return, and the max drawdown are all different numbers, right? So you may have a big effect up front, but the 1-year return tends to be positive when we move our perspective back a little, if you will. One thing that is true, that is when we do have this positive return, the annualized standard deviation during these periods, so look at Vietnam War, Gulf War, Iraq War, the markets are bouncing quite a bit, right? There's a lot of uncertainty, a lot of irrationality, and you can see that in the volatility, all higher than what your standard long-term volatility has been. You want to go over this slide, Cary?
Yeah, Amar. So, whenever these events happen, these corrections, be it war or other events that we've seen happen historically, when these events happen, emotionally, we feel like it's going to last for a long time. Like sometimes we feel like we may never recover, right? A 10% downturn feels much more serious than a 10% increase, right? And so, but if we use data to look at how we recover from these events, if you look out 1 year later, in almost all of these events, the returns have been positive a year later. And the further out you go, 2 and 3 years, which, if you have a long-term perspective, 1, 2, or 3 years is really a short amount of time. But the recoveries that happen after these events can be pretty amazing.
Yeah. Yeah, and visually, just looking at this chart here, a majority of this chart is above zero.
That's right.
Right? There's just a few instances where it's below zero and having negative returns. And like you said, 3 years is still considered short term when you have 20 years of longevity left, or 30 years, or whatever the number may be.
That's right.
In that relative. I'm going to switch to a different slide here. Let's see if I can do this effectively. All right, so I wanted to highlight this slide. Every year we have volatility. I mean, volatility is the price you pay to invest, right? Mm-hmm. It's part of the process. So what we have here on this chart is that you have in here the intra-year declines, like the max intra-year declines here on the bottom in orange, and then you have in dark blue what was a year-end result of that volatility. So here you can see, I don't know if this is coming up on my, it's not. I was trying to use a pencil to draw in here, but you can see, you can have large inter-year declines, but end the year positive. The more recent example of this is in 2020 when we looked at COVID. You had a minus 34% intra-year decline, followed by the full calendar year of plus 16.
Yeah.
Right. And so this type of volatility is normal. It's going to be, it's kind of the price you pay to invest. But what you do during these periods of volatility is very important. And you've got to separate emotion from having a process, a disciplined process that's following the data, right?
That's right.
The other page I'd like to highlight here is this page. This puts the other graphs in perspective over a longer period of time, right? The blue is the bull run in the markets, and the orange or yellow here is the bear markets, right? So a lot of times you see this big steep decline, and then we're in a bear market for a period of time, and then the market recovers and then comes back into another bull market. Visually here, you should see there's more dark blue than there is orange. So the key to investing is to stay invested through these periods by making sure that you have enough safety and margin, to make sure that you have enough cash so you can live your life, but to stay invested to capture as much of this bull market as possible.
Yeah. Just some experience to kind of put this in perspective, Amar. So, when I was working in the corporate world, I ran a large call center, right? That was financial advice call center. And our busiest call days historically would always be the downturns in the market, right? So the market is having a sell-off. Everyone's calling. Everyone's worried, right? And now thank goodness from a call center perspective and staffing on all of those concerns, those days were very few, right? What was normal was the days where we're seeing, either large or modest returns in the market, right? And no one's worried and everyone's pretty satisfied, right?
Yeah.
And
nobody's worried when the markets are going up, even when the volatility component can be high, right?
That's right.
Yeah.
But we would use sites like this to talk to people, right? To kind of help them put it in perspective, so that they don't overreact and make bad decisions. Unfortunately, some people just will still trade and make moves on emotion, right? But we would try as hard as we could to have them not make those kinds of moves.
Yeah. I mean, emotional decisions often feel protective in the moment, right?
That's
but
right.
can be very costly over the long run, right?
That's right.
So selling after a downturn, so you've already experienced the loss, missing the recovery, and locking in those losses because you didn't get back in, right?
That's right.
So that's key to kind of to keep that in front and center. Why don't we summarize here, Cary? I think we've done a good job of explaining the volatility.
Yeah. So, one of the things on those charts, Amar, was most of those events, or I would say none of those events, were predictable, right? Maybe people who really study, wars and geopolitical events could predict that event was going to happen, but certainly couldn't have predicted the day that it was going to happen or the timing around it, right? So these things are highly unpredictable, but this kind of uncertainty is why you get the kind of returns you get in the market, right? If everything was certain, we wouldn't see these kinds of returns. And so volatility and including, downturns are part of investing and part of portfolio management. And now for me personally, I think one of the biggest plugs for having a professional asset manager and a fiduciary doing that is they're more seasoned at removing the emotion, having that long-term view, not getting emotional, right? And not making decisions on emotion, but using data, right, to help their clients succeed. And so I think that's a good argument for having a professional asset manager, because in most cases they've been doing this for decades, right? And so they have the experience, they've been through multiple cycles, and they know what a cycle looks like.
Yeah. Yeah, and they have a disciplined process, I would say also, right?
Mm-hmm.
And that disciplined process takes the emotions out of making decisions, right? Like they already know what they're going to do when the data represents X, Y, and Z. Right?
That's right. That's right. So their decision making continues to be solid. It continues to be long term, and but also, but it's not absent of how clients feel and what they're going through, right? Because I know during these times we like to talk to our clients, right, and
Yeah,
and understand how they're feeling and help them through that as well.
Yeah, awesome, Cary. So if you have uncertainty or you are second guessing your portfolio investments or need help to kind of put this into perspective of what you own and what the process is, definitely have a conversation with us. We could be a good source to be a sounding board. You can contact us through our website. Our online portal has our phone number and email address, and we look forward to helping you. Thank you.
Okay, thanks, Amar.